So I'm David Benamou. I'm the CIO of Axiom Alternative Investments. So in a few words, we're an asset management established in Paris and London. We're specialized on financial institutions. We run a bit more than 1.4 billion exclusively on financial, mostly debt side, a little bit of equity. In terms of product range, we try to cover the full risk spectrum. We have funds that cover the 0 to 3% target returns with a volatility which is supposed to be below 2 or 3. You see, for example, this first green fund on the left-hand side here, Axiom Optimal Fixed, which is a fund which is very defensive. If you go a bit further up the risk return profile, this is again a fund about debt, but which a little bit more yields, and you will be looking at rather 3 to 5%, with of course a little bit more volatility. So you will look at 2 to 3% volatility. If you want to cross the 5%, you will step in more risky plays on the debt side. So Axiom Obligataire, which is one of our oldest funds, the oldest track record nearly in Europe on financial debt, fund that started in 2009. Roughly 8% of annualized performance in euro since its inception. It's a fund that is built to deliver 5 to 8%. A bit more risky again, with more volatility, a pure COCO fund. You may know what COCOs are, so these financial debt bonds. So here, it's really a beta play, so more volatile. More yieldy, of course, but more volatility on the downside. If you want to cross the 10% return, you have Axiom European Financial Debt, our listed fund, which is a kind of best of we can do on the asset class. So it's a fund that has a target return in excess of 10%. Volatility, of course, is higher. You will look at, let's say, around 5 to 6 in terms of volatility. And then the last one, Axiom Credit Opportunity. So this is a long shot fund on the credit side. It's an alternative fund. It's a fund that is targeting returns in excess of 12%, less directional than the previous one, but very specific in technical strategy because it's really based on credit derivatives. So very simply, there are 4 things that you want to keep in mind after this presentation. First of all, we're going to look into the industry fundamentals. And what the fundamentals are going to show you is that banks today are much more a credit play than an equity play. The second thing is that when you compare yield to the corporate bonds, for example, to the other sectors, it's still the sector that pays the most in risk-adjusted terms. So if you took, let's say, 2 bonds, if you compare the rating and the yields, in general, on financial, you'll have a higher rating and you'll be better paid. 3, there's a regulatory opportunity. That's probably the most interesting part. What's happening on banks and an insurance company is that the regulators have decided to change the rules. And on subordinated, what it means is that they have asked banks and insurance company to redeem their old stock of old securities and to replace them with COCOs. And that's where comes the interesting part. Banks are forced between brackets by regulators to purchase back, to redeem, to call and tender those securities. And on many occasions, they do it at premium. So that's where the value is. Last thing, it's a large market full of opportunity. So even though the trust would grow in size, we would still have a very interesting, let's say, room of maneuver to deliver the returns that our investors are expecting. So let's start with the industry and the fundamentals. In a nutshell, banks have completely been turned around. Basically today, banks really look like utilities, whereas in the past, we all remember that banks were considered a super leverage play, delivering 20 plus return on equity. This is over, definitely. Let's look quickly at the metrics. Capital. Today, banks are standing with 14.7% of core equity capital. It's very simply the highest numbers we've ever had in Europe. And it's not only about the figure. If you look into the rules that build this figure, the capital intensity today is much higher than what it was in the past. Today, the European banking industry stands with 3.2% of non-performing loans. It's again, very simply, the lowest level we've ever had in Europe. So what happened very simply is that since 2014, the European banks have sold, and often at loss, those portfolio of non-performing loans. And the 3.2% that you see today is not a result of the zero level cost of funding. It's the result of having sold down this exposure, and often that costs a lot of capital. So, of course, there's no magic. What happens when you triple the capital? Or what happens when you provision everything? Your return on equity looks miserable. That's it. So today, banks deliver, in average, 6 to 7%. The best in class will cross the 10% for the happy few. Rating agency, and you will see it on the bottom right-hand side, have perfectly understood that, because you are seeing, I would say since roughly 5 to 8 quarters, more upgrades than downgrades in the sector. So basically, you have a very strong positive rating momentum.
Thank you very much.